For a lot of homeowners, there could be thousands of dollars in tax savings hiding in plain sight, probably tucked away in a folder you haven't opened in years. What if I told you that one single document from when you bought your house could actually be saving you money year after year?
For a surprising number of people, the answer to that is a huge yes. We are talking about a federal tax credit that tons of eligible homeowners, especially those who bought their homes a while back, have probably never even heard of, let alone tried to claim.
It's called the Mortgage Credit Certificate, or MCC for short. And look, it was designed to make owning a home more affordable. But here's the catch. There's this massive gap between what the program promises and what actually happens. It's almost like having a winning lottery ticket, but having no idea how to cash it in.
So what is this thing exactly? Well, it's all governed by Section 25 of the Internal Revenue Code. And the MCC is a federal tax credit, and that's not the same as a deduction. A credit is way more powerful. It reduces your tax bill dollar for dollar. It's real money that goes right back into your pocket. It's usually issued by a state or local agency when you first get your mortgage, and it can seriously boost your savings every year.
But this is where we get to the real heart of the issue, this split reality. It's this clash between what the law is supposed to do and what homeowners like you actually have to deal with. On paper, it's a fantastic benefit. In the real world, it can be a total minefield of confusion and missed opportunities.
On one side, you've got the promise, right? A powerful dollar-for-dollar tax credit. But on the other side, you've got the operational reality, a maze of processing delays, documents that have gone missing over the years, and what the experts call statutory friction. All this stuff creates a huge information gap. Basically, the government has all the rules, but the taxpayer is left completely in the dark, and you could be losing out on thousands of dollars because of it.
Now, this isn't just some abstract problem. The risks are incredibly real, and they can be especially tough for seniors who might be on a fixed income. To really get a handle on the stakes here, let's walk through a cautionary tale that shows just how sideways things can go.
So let's meet Evelyn. Now, Evelyn got an MCC when she bought her house decades ago. And for years, she claimed the credit, no problem at all. But as time went on, her financial picture changed and she overlooked one absolutely crucial detail: the income limits. And this is the trap. You see, her income slowly crept up over the years, but she never went back to check the MCC's income limits, which, by the way, are adjusted for inflation. All of a sudden, she wasn't eligible anymore, but she had kept claiming the credit. This one simple oversight put her in a really tough spot, facing penalties and a potential liquidity crisis.
So how do you make sure you don't end up in Evelyn's shoes? How do you unlock this thing and make sure you're actually eligible? Well, it really all boils down to understanding the rules, both the easy ones and the not-so-easy ones.
Okay, the general rules, the ones laid out in IRC Section 25, they seem pretty straightforward. You usually have to be a first-time homebuyer, your income and the house's price have to be under certain limits, and it has to be your main home. Simple enough, right?
Well, you know how it is. The tax code is never that simple. The real power, and honestly the real risk, is hiding in the exceptions. It's in the little details that require you to put on your detective hat to find them.
And this is where it gets really interesting. That whole first-time homebuyer rule, it can actually be waived if your house is in a special targeted area. And here's a big one. If you sell your home within 9 years, you might have to pay back some of that credit. That's called the recapture rule. Oh, and refinancing can also mess things up, and there are often special exceptions for veterans. These are the kinds of forensic details that can literally make or break your eligibility.
Okay, so knowing the rules is one thing, but actually claiming the credit correctly on your Form 8396 without setting off alarm bells at the IRS, well, that is a whole other challenge. And this is where a lot of people run into trouble.
This brings us to what we can call the black box problem. Think about it. Most of the tax software we use at home, it just doesn't ask about the MCC, and it definitely doesn't keep track of those super important inflation-adjusted income limits from year to year. And get this, that one gap is why some experts think that a whopping 90% of people who are eligible either miss the credit entirely or claim it by mistake.
So this can lead to some serious red flags for the IRS. Claiming a really big credit, having information that doesn't match up across your return, or just forgetting to report a recapture after you sell your house, those are all pretty common audit triggers. And just like we saw with Evelyn, claiming the credit after your income has gone over the threshold is a major risk you really want to avoid.
So, how do you navigate this minefield and actually protect your own assets?
You need a proactive plan, a sort of playbook, a set of standard operating procedures to defend your financial well-being. So, let's build one.
All right, let's look at a totally different scenario. Let's meet Robert. We'll call him the architect of his own financial security. He also had an MC, but unlike Evelyn, he took a very different and much more successful path.
Robert was incredibly diligent. Every single year, without fail, he reviewed his income and checked it against the latest MCC thresholds. He didn't guess, he actually talked to a professional CPA. And he kept every single related document in what he called his legacy vault, basically a secure, audit-proof place for all his financial records. He left nothing to chance. Robert's success story gives us a really simple 3-step checklist. First, gather your documents. Go dig out that old closing paperwork and find that certificate. Second, verify your eligibility, look at the basic rules and all those tricky exceptions. And third, and this is key, monitor your income against the limits every single year.
At the end of the day, the IRS and IRC Section 25, they provide the pathway for this really powerful credit. The opportunity is there for the taking, for sure, but it's totally up to you to find that path, to understand it, and to walk it the right way.
So this leaves us with one final thought. That dusty old folder with your closing documents, it's not just a record of your past, it might actually be a map to your financial future. The only question is, what other hidden opportunities are just sitting there waiting for you to discover them?